Good morning. Thanks for joining us. Today is Friday, January 20th, 2023. A lot to get to today, so we'll just kind of jump into it. But we're going to start off with a question that we've had from one of our clients, and I'm sure a lot of other clients are interested in this, but that is related to the debt ceiling. We've had these discussions for at least the last 10 years, and I believe longer than that. I mean, I think going back to Newt Gingrich, I think we were talking about this. So right now, Janet Yellen, the Secretary of the Treasury, is saying that the Treasury is now going to take extraordinary measures to ensure that the U.S. continues to make payments to bondholders. And that'll last 5 months, which actually seems longer than they've had in the past, Tom. Typically, it seems like you got 45 days. And the 5 months is very much kind of hold a finger in the air. That's a long time in government life. So I would expect that it would last longer than that. But we've seen this with Democrats. We've seen this with Republicans. It seems like the Republicans use this a little bit more often than Democrats, but that might just be because the nature of the last 12 years, 16 years, who's been in office. So talk to us a little bit about what the move is now. Will the U.S. default on its debt in the near term? And how are they making ends meet currently?
Yeah, so I think it's super unlikely that anything along the lines of a default occurs. We saw this. It was really one of the first big splashes I saw when I first got on the bond desk, which was in 2011. We hit the debt ceiling. S&P downgraded the U.S. from AAA to AA1, and that caused a pretty short-term sell-off in fixed income, which at the time was, I would consider one of the bigger bumpier months. I want to say it was like October, maybe November of 2011 when that happened. But in terms of scale of how bumpy that is compared to the year we had in fixed income last year, I mean, it was a speed bump. There wasn't much that happened. Then again, in 2013, we hit the debt ceiling. We started with something called sequestration, which is basically they shut down any non-essential form of government for a time period. They basically furloughed everyone, but they kept on things like the mail, TSA, all the critical infrastructure. So it didn't really do anything that really long-term hurt anyone, but it did, kind of like the supply chain stuff, slow things down a little bit because there weren't as many people working for the government, and it caused some slowdown there, but it wasn't really that big a deal. It is unusual that we're talking about this so early. I'm not sure exactly which side of the aisle is pushing that to make sure that people know that it's about to occur, but it is very early on. It kind of goes both ways, right? The Republicans want to say, hey, this government's spending out of control. We want to make cuts. McCarthy just got in. He wants to throw his weight around and say, hey, now that we have control of Congress, we're going to really change things around here, and we're going to get more fiscally conservative. Democrats, on the other hand, can use this as hey, the Republicans are idiots. They can't even elect the Speaker of the House. They're just doing this because they don't know how to get anything done. So it kind of cuts both directions, politically speaking, but I think they're definitely going to get this done. The question is how quickly. My guess would be at the very last minute, like always. So we're probably going to have some volatility around this for quite some time, unless they just summarily figure out how to get the debt ceiling up and come to an agreement early. In terms of how they're making ends meet, they're basically moving money around as best they can. It's a lot like managing personal finance, right? You've got debt payments that are due, you've got cash that's coming in, and you've got to route that money in a way that makes sure that you don't have a credit card that's 30 days late. So the interest payments is really where it comes down to now, is making sure that they don't have any one issue, which there are, I mean, probably thousands and thousands of Treasury individual CUSIPs out there that pay pretty much every 7 days from now until 2053. They've got to make sure that those are paying and they're getting paid off, and the bonds that are maturing are getting paid off. So it's a lot of juggling, but I don't think it's as dire as you would imagine. You're going to see a ton of headline risk on this, where people are talking about it every day. And oh my gosh, the country's going to default, but it's very unlikely. The countries that do default are like Argentina or Zimbabwe or some of these countries where things are really a mess and they actually can't pay their debt.
Greece.
Yeah, Greece. Yeah, we can pay our debt. The question is, we're basically setting a credit card limit on ourselves, and we're getting pretty close to that limit. So we can't necessarily issue any new debt, but we got to make sure we're paying the stuff we have. And eventually they'll come to an agreement. But I mean, it is going to be a pain. And if there is a default or something like that, I mean, that would be political suicide for both parties, and it would cause a lot of economic hardship, and it would be just a disaster. So I don't think that's going to happen.
I'm curious to see how this ends up playing through to tax refunds, if that is a read through, because that could be the Republicans' angle. Because I think that at this point in time, it's not very smart to invoke the debt ceiling. I think it's a tried and true and frankly lazy tactic, at least from the outside when you look at it politically. But if then you can make the argument that the Biden administration is taking forever to get your money back, then you're not even going to talk about the reason, but it's a way to make the administration look worse. I think, again, that's a little bit of a flimsy tactic, but it is what it is.
Yeah. I mean, perception is reality. If you can make someone perceive that they're mismanaging it, then it might as well be true. But it's just like, I mean, think about companies like in that case with the tax returns, it's like, think of a company that has, accounts receivable coming in, but doesn't necessarily have enough to cover, if they delay payment of, their debts because they're getting a little bit more money in, then they can kind of kick that down the road as long as they stay within a reasonable range. It doesn't hurt anybody, but the more you do that, the further it is, the harder it is to get back to a point where you're ahead of things. So that's why they need to raise the ceiling.
We are seeing some news on some economic weakness this morning. You have Alphabet and Microsoft announcing layoffs. Alphabet announcing 12,000 layoffs, which is again, parent company of Google at 6,000, 12,000 employees, 6% of the workforce. Microsoft is laying off 10,000 people. Alphabet kind of did the normal, letter memo to employees saying that the people affected will be receiving a second email, and that if you have started the day working from home, you're allowed to work from home for the rest of the day to process all of this. The CEO, Sundar Pichai, said he takes full responsibility for this, and they're going to give generous packages. Microsoft, though, a lot more business-like. You think of Bill Gates, Steve Jobs, that era of businessmen. It was a little bit geeky, a little bit nerdy, but very tough when it comes to business. That's still very much in the Microsoft ethos. So the CEO there, Satya Nadella, is not taking responsibility, or at least he didn't say that in his memo. He said the subject is focusing on our short and long-term opportunity. And he went through 3 reasons why they're doing this, basically aligning cost structure with revenue and customer demand. They're committed to working throughout the process in a thoughtful and transparent way, looking to invest in strategic areas, and operating with dignity and respect. But again, he's not saying he takes responsibility like Zuckerberg did and like Sundar Pichai did. And then finally, he says in his second to last paragraph, and it comes across as a little bit tone deaf. I understand what he's trying to do, but it's a little bit tone deaf when he says this, quote, "When I think about this moment in time, the start of 2023, it's showtime for our industry and for Microsoft. As a company, our success must be aligned to the world's success. That means every one of us and every team across the company must raise the bar and perform better than the competition to deliver meaningful innovation." I don't know. I think it could be received well, but for a lot of people, especially the ones getting laid off, I think that comes across as extremely, tone deaf.
Callous.
Yeah.
I mean, it seems like, people always talk about how decades go in cycles. I kind of feel like we're headed into a very 80s style of maybe the 2020s is going to be a repeat of the 80s, which is we're moving away from feelings, right? And 90s, 2000s, everyone's like, man, this is how I feel. We're feeling. You go to Microsoft, you got ping pong tables, unlimited Starbucks. But now, things are getting tougher. Obviously, the economic landscape has changed from just the boom we've had since 1990, and it's time to get back down to brass tacks. And honestly, I think that's the way we need to move. I mean, which would you prefer? A CEO comes in and says, "Hey, we're firing people. I don't feel bad about it. The company is my responsibility. My responsibility to the people who are still here. Let's, it's showtime. Let's grind. Everybody needs to pull their share." Or the guy's like, "Man, I just can't sleep at night. It's just horrible. Everything's terrible, but, sorry for everybody." Meanwhile, he's cashing a big check, I think it's at the very least, I think it's more honest. Does it make people feel bad? Yes. Are people really worried about their feelings in 2023? Yes. But I mean, at the end of the day, the show must go on, right? So upward and onward, it's tough, but that's life. Life is suffering, according to the Buddha.
Nordstrom also cutting its profit expectations by 35%. And it's all coming on the margin side. They thought they were going to do 4.2% margins, which, by the way, to do a 4.2% margin is extraordinarily thin. I mean, if you're off by, if you thought you were going to mark stuff down, it's, you're getting 98%. And it's like, no, you have to do 97% of list price. You just cut your profit by a third. And that's what Nordstrom's doing right now. They had heavier than expected markdowns, especially at Nordstrom Rack. The higher end brand, Nordstrom, the Nordstrom banner was only down about 1% in terms of revenue. So that's holding in a little bit better. But Nordstrom Rack is down 7.5% because the lower income consumer is really starting to feel it a little bit more. The higher end consumer has a little bit more resilience. We are seeing people move from, we listened to Guess, the jeans company at the ICR conference we went to, and they said that we are moving from a period of casual to quote unquote dressy, which should favor a company like Nordstrom, but Nordstrom is routinely in the past 5 years misstepped in terms of its inventory. They misstepped again, and they had to mark down a lot more than they thought. On top of that, but they do think the inventory is in a good spot now. They feel like things are good. They had to mark down more than they thought, but they think they got to a good spot. This is why we saw some of the concerns that Macy's had that we addressed on our macro presentation. But it's not good when you see a 35% cut to earnings per share. That gets investors to sit up, and I think that's what we'll see. Do you make a read from this quarter into the broader economy? I think that a lot of this news we kind of already knew. It was always going to be tough for Nordstrom to beat those expectations in that environment, but I think people will try to extrapolate that.
Yeah, I think that, if you think back to the past year, I feel like the max economic pain hit somewhere between late October and early November. And I think that we're starting to see that filter through the earnings. I think things have eased a little bit since then. I think that inflation has eased a little bit since then. And so I don't know that you can technically draw, what 2023 is going to be like based on, the early parts of Q4 2022, because it was just, inflation was super high. People were starting to get laid off. Things were really looking bleak. And I think we've sort of come out on the other side of that. So that's kind of how I would read it. But, obviously Nordstrom is along the lines of a JCPenney or a Macy's. These are dying industries. The mall-based clothing store is not something that, is considered an unbelievable business. So I wouldn't read that so much either.
On the other hand, Netflix is seeing that people continue to pay even though they increased their prices and are coming out with this ad-supported platform. Ad stock's up about 7% pre-market. Reed Hastings is stepping down as CEO. He served that role for 25 years. Greg Peters, the chief operating officer, is moving up into the CEO role. Good news for Netflix shareholders who have had a really tough 18 months as they move forward. We also had Eli Lilly file. They received a response letter from the FDA. They're trying to get their Alzheimer's treatment called donanemab approved, and they had an application in for accelerated approval, which could have allowed the drug to have reached the market in the first half of this year. That is not going to be the case. The FDA issued a letter last night saying that they didn't have sufficient people in the study. Eli Lilly's response was, look, we had enrolled 250 people in the study. And the problem was we took half of them off. We took well more than half of them off the drug within 6 months because their amyloid in the brain had gone. The drug had worked. And so we took them off as per the protocols in the study. That's what we said we were going to do. If we reached an endpoint earlier than expected, we were going to take them off. And the FDA said, well, we don't have a full year of data on those guys. We only have 60 patients. And that's less than the 100 that you promised us. And so we're going to deny your application for accelerated approval. So not good news for Eli Lilly. If their argument holds up and is actually true, it seems like the FDA is probably being a little bit too literal. Yeah. Especially when you consider what they just did with Biogen. They met with those guys 200 times in the last year.
Or I don't know, some other things that were fast tracked that may or may not have been so effective.
So, that's a problem when you start to get into these things. I think by the letter of the rule, I think that the FDA probably did the right thing. And you got to be confident that Eli Lilly is also telling the truth.
Yeah.
They have a pretty good track record, Eli Lilly does. Nevertheless, clearly someone was ineffective this time. Either Eli Lilly's lobbyists were ineffective, their communications team that announced this ruling was ineffective, or Biogen's lobbyists were just unbelievably effective and lobbied the FDA strongly to deny this.
I mean, I'm going to choose to believe everybody, which is one, it's probably a good thing that if the drug works and they had to stop giving it to people because it had cleared up the problem, that's good news. And if the FDA said, hey, we need to see more information before we send a drug out into the world, I think that's also good news. So, short-term setback to a long-term comeback for Eli Lilly, but the stock is down this morning. So,
yeah, down about 2%. It was a broadly expected approval, actually. Next week, we have a lot going on. We have a lot of earnings reports coming on, including Microsoft on Tuesday evening. You also have on Wednesday morning, you have Boeing, and Wednesday evening, you have Tesla, which will be very interesting because those deliveries have seemed to have slowed down significantly. And then on Thursday evening, you have Visa, Intel, and then Friday morning, you have HCA, which we've talked about, and American Express. So we're going to be keeping an eye on those earnings reports. We're also going to be keeping an eye for Monday because Monday, Jason Sieb, an analyst with us, will be speaking at the Hedge Week panel, and we'll figure out how to send a link if you're interested to that. He's going to be talking about how we use experts to inform the mosaic of how we analyze stocks. So that'll be a really interesting interview. I talked with him a lot at length about it yesterday, and I think it's going to be some good content. So on that note, we'll leave it there. Have a great weekend, and we'll see you on Monday.